Right now, as we speak, Datavault AI Inc., trading under the ticker DVLT on the NASDAQ, is sitting at 0.71 USD, marking a slight decline of about 0.83% for the day. While a move of less than a percent might seem like noise in the broader market, it actually tells a very specific story about the current tension between retail hope and institutional hesitation. Most people looking at a sub-$1 stock see a lottery ticket or a forgotten tech play, but the reality is that Datavault is currently navigating a liquidity trap that most investors haven't even noticed yet. While the general expectation is that any company with AI in its name should be riding the coattails of giants like Nvidia stock or the recent surges in Apple stock, Datavault is finding that the market is no longer handing out participation trophies just for showing up to the party. The curiosity loop here isn't about whether they can build a product, but rather why the price action is detaching from the broader sector momentum. Usually, when the tech sector breathes, these small-cap AI plays gasp for air. But today, we are seeing a stubborn sideways grind that suggests a massive standoff between short sellers and a very loyal, albeit quiet, group of long-term holders. The common belief among those browsing through popular investing sites or scrolling through the Robinhood app is that small-cap AI is the next frontier for massive gains. People look at the historical runs of Tesla stock and hope to catch that lightning in a bottle with a penny stock. However, the reality we are seeing on the tape today suggests that the market is applying a much harsher discount to Datavault than its peers. Why? Because the expectation was a rapid scaling of their data security and valuation protocols, but the reality is a complex regulatory environment that is slowing down enterprise adoption. If you're using SoFi Invest or a Fidelity brokerage account to track this, you'll see the volume is sitting just below the 30-day average, which indicates that the big money, the firms using interactive brokers or high-end Fidelity wealth management services, is waiting for a specific catalyst before committing. They aren't selling off in a panic, which is why we only see a 0.83% dip, but they aren't buying the ask either. This creates a fascinating vacuum. Looking at the intraday movement, we saw a brief attempt to break the 0.73 level early in the session, which was met with immediate resistance. This tells us that there is a ceiling of convenience where traders are taking profits the moment they see a green candle. This behavior is typical for stocks in this price range, but for Datavault, it's particularly telling of the lack of a strong hand buyer at the moment. When you look at the order flow on a professional Fidelity trading platform or the deep books on interactive brokers, you notice a lot of small lot trades. This is the hallmark of retail activity. The institutional activity, the kind that moves the needle and creates sustained trends, is currently sidelined. They are looking at the macro picture, interest rates, the strength of the dollar, and the overall appetite for risk. In an environment where you can get a guaranteed return on cash through Schwab Intelligent Portfolios or a Fidelity cash management account, the hurdle for a company like Datavault to prove its worth is much higher than it was 2 years ago. The volatility we've seen over the past few weeks isn't just random. It's a reflection of the company's struggle to bridge the gap between being a concept and being a business. The market is currently valuing them as a concept. To shift that valuation, they need to show recurring revenue that isn't just tied to pilot programs. For those of you watching this closely, I want to hear your take on the sector. Comment below how many shares of Datavault you are currently holding, or if you're choosing to rotate that capital into something like Nvidia stock instead. It's important to understand where the community sentiment lies, because in small cap land, sentiment is often the only thing keeping the lights on until the fundamentals catch up. We're seeing a lot of people moving their online investment strategies towards self-investing via the Robinhood app or SoFi active investing, looking for these high upside plays. But the risk management side, the side that uses Fidelity ETFs or Fidelity mutual funds to balance the portfolio, is what keeps people in the game long term. Technically, the 0.70 mark is a psychological line in the sand. If we drop below that, the next support level is quite a bit lower, which could trigger stop-loss orders across various investing sites and automated platforms like a SoFi robo-advisor. On the flip side, if the 0.71 hold turns into a base, we might see a short cover rally. But let's be real. Rallies in this sector are currently being sold into. The broader market narrative is focused on flight to quality. Investors are moving toward names with massive balance sheets like Apple stock. Datavault doesn't have that luxury. They have to fight for every inch of ground. Their business model, which centers around the valuation and monetization of data assets using proprietary AI, is brilliant on paper. It solves a problem that many large corporations don't even know they have yet: how to put a dollar sign on the petabytes of information they store. But the lag between identifying a problem and getting a CFO to sign a check for the solution is where companies like Datavault often get stuck. The institutional activity over the last quarter shows a mixed bag. Some smaller hedge funds have nibbled, perhaps using an Interactive Brokers account to stay nimble, while larger Fidelity Wealth Management clients are likely nowhere to be found here. This is an individual brokerage play, a self-directed bet. When you look at the recent earnings call or the filings available on your Fidelity mobile app, the focus has been on strategic partnerships. In the world of small-cap tech, strategic partnership is often code for "we're trying to find someone to pay for our R&D." While that's not inherently bad, it does add a layer of uncertainty. The reality is that the market wants to see a clean, standalone success story. They want to see Datavault prove that their AI can actually create a new asset class out of thin air. The sector momentum is also headwind. While the massive tech names are hitting all-time highs, the long tail of the AI sector is actually suffering. It's a K-shaped recovery within tech itself. The winners are winning big, and the smaller players are fighting for crumbs. This is why you see the price at 0.71 today, while the NASDAQ as a whole might be green. It's a divergence that should make any serious investor pause and think. Are you buying a future leader, or are you catching a falling knife? The expectation was that the AI tide would lift all boats. The reality is that the tide is only lifting the ocean liners, while the smaller vessels are getting tossed around in the wake. This is where your investment help and research come into play. You can't just follow the crowd on social media. You have to look at the intraday figures, the volume profiles, and the macroeconomic pressures that affect a 70-cent stock differently than a $700 stock. If we look at the history of the company, they've gone through several iterations to get to this point. They started with a broader focus on data management before narrowing down into this AI-driven valuation niche. Past performance hasn't been stellar, which is why the current price is where it is. But the past is a ghost. It only matters if it dictates the future. The risk here is dilution. Many companies at this level have to issue more shares to keep the lights on, which can hurt those who bought in early via their Robinhood investments or SoFi active accounts. You have to watch the filings for any sign of a secondary offering. If they can avoid that and secure a major contract, the 0.71 price point will look like a gift. If they can't, it might just be a pit stop on the way down. The future outlook depends entirely on one thing: execution. The AI narrative is shifting from what is possible to what is profitable. We're entering a phase where investors using the Interactive Brokers platform or Fidelity Trading platform are looking for margins, not just memes. Datavault has the intellectual property, but do they have the sales force? Do they have the market penetration? The catalysts to watch are any news regarding government contracts or integration with larger cloud providers. If they can get their tech inside a major ecosystem, the expectation versus reality gap closes instantly. But until then, we are in a period of discovery. To summarize, Datavault AI is currently a study in market patience. At 0.71 USD, it's down slightly today, reflecting a lack of immediate buying pressure, but a refusal to collapse. The expectation of an AI-driven moonshot is being tempered by the reality of a cautious, high-interest rate environment where Invest Online users are becoming more selective. While names like Tesla stock or Nvidia stock dominate the headlines, companies like DVLT are the ones where the real drama happens in the quiet corners of the market. You have to decide if you believe in the narrative of data valuation or if you think the market is right to be skeptical. The contrast between the high-flying tech dreams and the gritty 0.71 per share reality is where the opportunity and the danger lies. Keep a close eye on the volume. If it starts to spike without a price increase, someone is exiting. If the price moves up with low volume, it's a trap. But if both move together, then the reality might